You're sitting on $168 billion of cash, which you told us today is now more than $182 billion. What is Buffett waiting for?
I wouldn't basically see many more opportunities than we found. Now, it's true that something like Japan, we could have got a hunger strike or something like that going on. It's just that things aren't attractive. Don't tell the Federal Reserve that, but
He is as bearish as he ever gets. I read right between the lines, right from the beginning at the meeting on Saturday. I was there sitting in the audience, and I thought, okay, huge cash position, trimmed his Apple position. He's nibbling on something below the surface they haven't announced yet. But basically, he is waiting until the next 40% decline in the stock market to apply massive amounts of capital at bargain prices in things that are large enough to be meaningful to this company at the size it is now.
Warren Buffett is widely regarded as one of the greatest investors of all time. Each year, his annual Berkshire Hathaway conference prompts intense scrutiny, with analysts dissecting every word he says. This year, the focus was unmistakably on Berkshire's enormous cash reserve and their potential implication for the broader economy. Many interpret these developments as a signal from Buffett that a significant economic downturn might be on the horizon and that his cash buildup is a precautionary measure. It's a common inference that when an investor holds back from deploying their cash reserve, they view the market as offering limited attractive opportunities. With Berkshire Hathaway's cash reserve soaring to $189 billion, speculation is rife that Buffett sees the market as excessively overvalued. Considering the 500 companies listed in the S&P 500, the inability to find enough suitable investment is telling. The accompanying chart illustrates the unprecedented size of this cash reserve. One frequently cited reason for this buildup is the appeal of current cash yields. Buffett clarified that his $189 billion isn't held in literal cash, but in cash equivalents, primarily short-term US Treasuries. While this might seem confusing, it means these holdings generate a yield. Currently, a 3-month US Treasury offers about a 5.4% return, making them a highly attractive and secure investment. However, Buffett emphasized during this year's conference that even if the yield were as low as 1%, it would still maintain the same level of cash reserve. He articulated this belief clearly. If Buffett isn't focused on chasing yields and genuinely struggles to find worthy investment avenues, it naturally suggests he views the current market as excessively inflated. This sentiment aligned with the common belief that an overvalued market must eventually correct itself through a downturn to reach fair valuation. Many observers extrapolate from Buffett's action that he is anticipating such a correction, even if he is reluctant to explicitly state it. In 2001, Buffett introduced his own market valuation indicator, now famously known as the Buffett Indicator. This metric compares the US GDP to the total market capitalization of publicly traded companies, essentially just opposing economic output against corporate values. Buffett himself hailed it as perhaps the most insightful measure of market valuation. Currently, the Buffett Indicator sits at 199%, indicating significant overvaluation, nearly 2 standard deviations above historical norms. Historically, such elevated levels have preceded substantial market downturn. Unlike many in the finance world, Buffett and Berkshire Hathaway refrain from predicting recession, openly admitting their inability to forecast such events. However, their approach can be distilled into a simple theory, recognizing overvaluation and waiting for market force to correct it. Presenting investment opportunities, Buffett comprehends that while timing and specifics of these corrections are uncertain, the present abnormality is likely to transition rapidly over time. Toward the end, Buffett's statement encapsulates a sense of anticipation for potential shifts, implying an awareness of the evolving landscape. Essentially, he is alluding to the widely recognized sign indicating severe overvaluation across various metrics, while limited to the Buffett Indicator alone. For instance, the 10-year Treasury yield curve, a reliable recession predictor over the past half-century, has remained inverted for over 630 days, surpassing its previous record set in 1978. An inverted yield curve signifies short-term bond yields more than longer-term ones. typically indicating investor anticipation of short-term economic struggle and long-term optimism, while the curve remained below zero, suggesting inversion persists. It's when this line returned to positive territory that recession signals typically emerge. Presently, there is no definitive indication of this reversal, but given the record-breaking duration of inversion, speculation mounts about an impending recession. Buffett's cautious approach aligned with Berkshire investors, understanding that he seldom expresses bearish sentiments overtly, given the unpredictability of recession timing. However, astute investor can glean insight by reading between his lines. According to Bill Smith, Chief Investment Officer at Smith Capital Management, Buffett's current stance is arguably his most bearish yet. For further insight, let's delve into an interview clip from CNBC where Smith elaborates on his contentious analysis.
Warren Buffett is a super nice guy, and he has absolutely no interest in offending people. But if you look at what he's doing, he is as bearish as he ever gets. I read right between the lines, right from the beginning at the meeting on Saturday. I was there sitting in the audience, and I thought, okay, huge cash position, trimmed his Apple position. He's nibbling on something below the surface they haven't announced yet. But basically, he is waiting until the next 40% decline in the stock market to apply massive amounts of capital at bargain prices in things that are large enough to be meaningful to this company at the size it is now.
So you just used the phrase, this is as bearish, I believe you said, as I have ever seen him. Is that really the right characterization, or is it rather that he thinks the market is too highly priced for him to go in a big way and put fresh capital to work? In other words, is it so much a bearish call as it is a rejection of the idea that this is an opportunistic time to invest?
Tyler, you have asked a great question. So I'm going to answer this in kind of an odd way. In 1969, he pivoted from being primarily a quantitative Ben Graham value guy to being more of a Charlie Munger qualitative guy, right? Get a reasonable price on a great company. And he said back in 67, 68, 69, that the quantitative ideas that he used to like to buy were combed and recombed. That was his letter to partners. And this last year, he said that the kind of things that we would like to do have been endlessly picked over. So that is code for, we think the market's expensive, we're not in any hurry, we're going to wait. And remember, he's talked constantly for 10 to 15 years that the bigger Berkshire gets, the more it limits their opportunities.
Right.
So really, to have very large opportunities for large deployments of that $200 billion, you've got to have the entire market get into very difficult circumstances.
In essence, there is mounting speculation that Warren Buffett may be apprehensive about an impending recession, driven by observation of his cautious behavior and exponential growth of Berkshire's cash reserve. Key indicators, such as the Buffett Indicator, underscore the substantial overvaluation of stocks, historically rectified by economic downturn. Moreover, signals like the 10-year yield curve inversion provide additional cause for concern, hinting at potential economic turbulence ahead. Thank you for tuning in. If you found this content insightful, please remember to like and subscribe. Feel free to share your thoughts on the market outlook in the comment section below.